The banking establishment just delivered a message that could reshape your financial future forever. December 10th marked a pivotal moment that most Americans completely overlooked. While families gathered for holiday celebrations, the Federal Reserve made a decision that could trigger the largest precious metals surge in modern history. Here's what happened behind closed doors. The Fed cut interest rates by another quarter point, bringing the federal funds rate down from its previous levels. But this wasn't just another routine policy adjustment. This was a desperate attempt to prevent an economic catastrophe that's been building for years. Let me paint you the real picture. Private sector employment just shed 32,000 jobs in a single month. That's the steepest decline we've witnessed in 2.5 years. Main Street businesses are shuttering their doors. Wage growth has frozen solid. Consumer spending is collapsing at alarming rates. The Federal Reserve sees the writing on the wall. John Williams from the New York Fed recently acknowledged they have significant room to lower rates further. Translation? They're preparing for economic warfare, and gold could be your shield. Now, before we dive deeper, let me be crystal clear. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with any organization mentioned here. This is purely educational analysis based on publicly available information that every American deserves to understand. What we're witnessing isn't just monetary policy. It's the beginning of what I call a confidence crisis. The dollar index recently plummeted below the psychological barrier of 100. Think about that for a moment. The world's reserve currency is showing cracks in its foundation. Here's the data that should concern every thinking person. Back in 1999, the dollar represented roughly 71% of global currency reserves. Today, that figure has dropped to approximately 58.4%. The dollar is hemorrhaging market share, and smart money is flowing somewhere specific. Central banks worldwide are panic buying gold at unprecedented rates. We're talking about 1,000 tons annually for 3 consecutive years running. These aren't emotional retail investors making impulsive decisions. These are sophisticated financial institutions with access to information most people never see. Kazakhstan has been purchasing record quantities. Brazil just made their first significant purchase in 4 years. Poland is reportedly targeting 30% gold reserves. 30%. These nations understand something that Wall Street doesn't want you to know. For the first time since 1996, central banks now hold more value in gold than in United States Treasury bonds. Read that again. More gold than American debt. That's not just a portfolio shift. That's a revolution happening in plain sight. The pattern we're seeing has played out 3 times in modern history, and each time, ordinary people who didn't prepare paid an enormous price. Let me walk you through these historical precedents because they reveal exactly where we're headed. 1933, America was drowning in the Great Depression. Banks were collapsing daily. Unemployment reached 25%. Franklin Roosevelt made an unprecedented decision. Executive Order 6102 mandated gold confiscation from American citizens. People had to surrender their gold at $20.67 per ounce or face serious legal consequences. Then, once the government controlled all the gold, they revalued it to $35. That's roughly a 40% devaluation overnight. Citizens lost purchasing power while the government gained complete control. August 15, 1971. Vietnam was bleeding America's resources dry. France famously sent a warship to collect their gold reserves. A warship. The Bretton Woods system was cracking under pressure. Nixon went on national television and ended the gold standard with one speech. What happened next? Gold exploded from $35 to over $800 by 1980. Inflation devastated the economy. Oil shocks created stagflation. The dollar collapsed. But gold became the asset people trusted when everything else failed. 2008. Lehman Brothers vanished overnight. Bear Stearns disappeared. AIG required taxpayer bailouts. The Federal Reserve printed trillions of dollars, literally creating money from nothing. Gold climbed from around $700 to $1,900. Why? Because people understood a fundamental truth. When governments print money recklessly, gold protects. When trust erodes, gold survives. When systems reset, gold becomes the bridge to stability. December 2025 represents the same pattern playing out again. United States debt recently surpassed $36 trillion. $20 trillion of that matures within the next decade. The government faces two choices: pay it off or roll it over. They cannot realistically pay it off, so they'll attempt to roll it over. But here's the mathematical trap they've created. Interest rates jumped from near zero to around 5% in roughly 18 months. The cost of servicing this debt is consuming the federal budget. This is why the Fed is cutting rates. Not because the economy is thriving, but because the debt structure has become mathematically unsustainable. If they don't cut, the system faces immediate pressure. If they do cut, inflation could return with vengeance. Gold reflects this impossible situation. Gold always reflects monetary reality. The precious metal is consolidating just below resistance levels, coiling like a spring under pressure. Technical analysts suggest if it breaks above key levels, the next stop could be $5,000 per ounce. But there's another signal most people are ignoring. Silver recently touched nearly $59, up roughly 97% this year. When silver outpaces gold, it signals two critical developments. Industrial demand is exploding, and investors are rotating into hard assets across the board. The World Gold Council recently released projections suggesting gold could surge another 15 to 30% in 2026. Conservative estimates put the target between $4,800 and $5,500. More aggressive scenarios discuss $6,000, $10,000, even $15,000 per ounce. Some analysts studying historical patterns mention $38,000 or even $138,000. Those numbers might sound impossible until you understand the theoretical revaluation framework. The United States government officially values gold at $42.22 per ounce. That valuation hasn't been updated since 1973. If the government decided to reset gold's value to back the $36 trillion debt, simple mathematics suggests $138,000 per ounce. Whether they actually possess that gold remains questionable. The last comprehensive audit of Fort Knox occurred in 1953. 72 years have passed without public verification of the full inventory. Here's what really concerns me about the current situation. We're not dealing with normal market dynamics anymore. This is what I call systemic breakdown, and it's happening faster than most people realize. Look at what's actually occurring beneath the surface. The Federal Reserve ended quantitative tightening around December 1st. They stopped draining money from the system. Now they're cutting rates again. That's not just policy adjustment. That signals fundamental recognition that something is seriously wrong. While they were supposedly fighting inflation, the labor market took a devastating hit. Small businesses are closing their doors. Wages have flatlined completely. Consumer spending is collapsing. The Fed sees these warning signs and they're panicking, but here's where it gets really dangerous. Because this isn't just about America anymore. The entire global monetary system that's operated for 80 years is being restructured. Not adjusted, not modified, completely restructured. Countries are preparing for what comes next. China hasn't disclosed real gold reserves in years. Russia dumped treasuries and loaded up on gold. Saudi Arabia is signing oil deals in yuan instead of dollars. The petrodollar system that's existed since 1974 is showing serious cracks. When that system breaks, and all evidence suggests it will, gold becomes the universal language again. Why? Because institutional trust is evaporating, but gold carries 5,000 years of proven reliability. Let's examine the technical picture for just a moment. Gold attempted to break through 42.50 multiple times, failed, then pulled back to around 41.64. Support held firm. Now it's consolidating, building pressure like a coiled spring. If it breaks below approximately 40.85, we could see further pullback. But if it breaks above 42.50, technical analysts suggest the next stop could be 5,000. After that, there's minimal resistance. No clear ceiling. Just pure momentum potential. Once psychology shifts from asking whether prices are too high to wondering how high they can go, that's when things become exponential. Most people aren't paying attention to the silver signal either. Silver is gold's volatile younger brother. When gold moves, silver typically follows. But when silver starts dramatically outpacing gold, that's worth serious attention. It's telling us two critical things. Industrial demand is absolutely exploding. Solar panels, electric vehicles, 5G infrastructure, artificial intelligence data centers all require massive silver consumption. Second, people are rotating into hard assets broadly. Not just gold, everything tangible. Because paper promises are losing perceived value rapidly. Every major commodity crisis in history follows the same four-stage pattern. Stage 1 creates abundant supply and complacency. Stage 2 brings surging demand while supply can't respond. Stage 3 involves recognition of structural deficit. Stage 4 triggers price dislocation and panic. We're deep into Stage 3 right now. COMEX silver inventories dropped 60% in 4 years. Global mine production peaked and is now declining. Industrial consumption is doubling while supply stays flat. The math is unavoidable. When physical supply can't meet industrial demand, price becomes the only adjustment mechanism. And it's never smooth. It's violent and sudden. Here's what keeps me awake at night. The scenario where major industrial players publicly announce they cannot source enough silver. That triggers the cascade. Other firms panic buy. Governments secure supply for strategic industries. Investment demand explodes. The paper market breaks completely. Exchanges change rules, restrict delivery, force cash settlement. It's happened before with other commodities. It will happen again. When physical decouples from paper, when industrial demand meets monetary demand, when solar panic combines with currency crisis, silver won't rise steadily. It will gap $50, $75, $100 overnight. But let's get back to gold and what this means for your financial future. Every single time gold made a massive move throughout history, people said the exact same thing. They called it fear-mongering. They said it was impossible. In 1971, they doubted $100. In 2008, they doubted $1,000. In 2020, they doubted $2,000. Now at $4,200, some are still doubting. But the people who positioned early aren't doubting anymore. They're prepared. Because they understood something fundamental about how gold actually moves. Gold doesn't surge primarily because of speculation. Gold moves because of fear. Fear of inflation, fear of conflict, fear of collapse, fear of the unknown. Right now, all four factors are arguably in play simultaneously. So what happens next? Here's the most likely sequence from my perspective. The Fed's December rate cut could trigger gold to rally and potentially break through 4,250. Momentum could accelerate dramatically by early 2026. Gold might test 5,000, and there's no telling where momentum stops after that. But here's the critical nuance most people miss. This rate cut probably isn't the start of a long easing cycle. It appears to be a desperate tactical adjustment. The Fed is trying to thread an impossible needle. Support the labor market without reigniting inflation. They can't easily accomplish both objectives. Cut too much, inflation returns with vengeance. Cut too little, unemployment could spike dramatically. Either scenario, gold wins decisively. In a stagflation environment historically, gold is one of the few assets that can hedge both sides effectively. It hedges inflation, it hedges recession. That's exactly why central banks are buying aggressively. That's why billionaires are rotating portfolios. That's why everyday people are finally waking up. This story isn't confined to traditional financial news anymore. It's spreading across social media, forums, everywhere. People are calling this the trust shock. Some say gold at 4,200 isn't just an investment anymore. It's a currency crisis warning system. Central banks appear genuinely concerned. That's the clearest signal possible. Even the cryptocurrency community is connecting gold's surge to capital rotating out of fiat currencies entirely. First into gold, then potentially into Bitcoin and other alternatives. Whether you believe those projections or not, the point remains crystal clear. The narrative has fundamentally shifted from asking whether gold is a good investment to questioning whether the entire system is under stress. When narratives shift that dramatically, crowds typically follow the new direction. The Federal Reserve's December rate cut wasn't just monetary policy. It was a distress signal. A mathematical admission that the debt trap they've created has no clean exit. When the world's most powerful central bank starts cutting rates while inflation risks remain elevated, that tells you everything about the impossible position they're facing. History shows us what comes next. In 1933, 1971, and 2008, the same pattern played out. Currency crisis, gold surge. Wealth transfer from paper holders to those positioned in real assets. The only difference this time is scale and speed. You have a choice to make right now. You can wait for absolute proof that the system is breaking, but by then gold could be $8,000 or $10,000 per ounce. Smart money isn't waiting. Central banks aren't waiting. Billionaires aren't waiting. This isn't about getting rich quick. This is about protecting what you've built when the mathematical reality of 36 trillion in debt collides with economic necessity. Gold doesn't have counterparty risk. It doesn't depend on government promises. It just exists, holding value like it has for 5,000 years. The Fed's final rate shock has begun. Gold is responding exactly as history suggests it should. The only question remaining is whether you position yourself for what's coming or watch from the sidelines as the largest wealth transfer in modern history unfolds around you.